GameStop has been talked a lot about over the past couple of months. From their refusal to close their US stores during the pandemic and their huge losses, to the new activist investors, there are a lot of people with very different views on this company. Some people are even claiming a stock price of $50 a share. At time of recording this, it's around $6 a share. So it's quite a lot of extremes with this company. So let's take a deep dive and find out the strengths and weaknesses of this business and see if it's a good investment. Hello and welcome. I'm Wayne from WES Investments, bringing you stock market news, portfolio updates and training on how to make money in the market, all on this channel. So if you're new here, consider subscribing, and if you're interested in learning about the stock market, I have other options outside of YouTube, so please check the description below to find out about being things like my Patreon. Now the boring bits first. I'm not a financial professional, this is not financial advice. You do need to do your own research and make your own decisions. So GameStop is most definitely a controversial company. So first of all, I'm going to go over its strengths, along with opportunities for the business and why it could be a really great investment. And then I'm going to go over its weaknesses and see what could stop someone from investing in it. So GameStop, if you don't already know, is a global company that sells you new and used computer games, consoles, accessories, consumer electronics, and what I would call geek toys. They also buy them off you as the customer and then sell them back to other customers at a higher profit. They own a number of different brands like ThinkGeek, which has some of its own stores as well as being part of other game stores. Electronics Boutique is another, Micromania, both of which are quite similar concept stores, and they're based in Canada, Australia and France. And they also have the Game Informer magazine as well. Globally, they have around 5,000 stores, which I say around because they've been closing down a lot of their loss-making stores. Michael Burry.
I don't know how to be funny. I don't know how to work people. I just know how to read numbers.
This guy is an investor in GameStop. And for those of you who don't know from that short clip, it's the character who Christian Bale plays in the film Big Short. And if you haven't seen it, it's a good watch. Make sure you do. Well, he joined early in the year using the reasoning that the business had a lot of cash on hand. I think he saw this as a value play, with the fact that the value was actually worth more in parts than the market had actually valued it for during the crash. As well as Berry, we also have a number of activist investors, including BlackRock, Fidelity, and Ryan Cohen, who Ryan Cohen has just bought 10% of the company. And if you don't know him already, he founded Chewy, which is a huge online retailer for pet products that created an environment for pet owners that is focused on the customer experience and creating a community for this customer.
I really think it's all about creating an experience for the customers, and so if you're going to, invest in physical stores, it really needs to be focused on delivering an experience where people want to bring their pets into the store. And so I think it depends on the category, but to the extent that retailers are focusing on creating an amazing in-store experience, then I think omni-channel strategy can make a lot of sense.
I believe a big reason that Cohen got involved in this process is because he sees the same thing happening with GameStop as he was doing with Chewy. On the board of directors for the company is a guy called James Schmancy. I don't know if I've pronounced that right, but he was elected to join at the start of the year and came from Chewy. So it's likely that he has convinced Cohen to invest in the company. It is very promising when a board member is able to convince an investor like Cohen to invest such a large amount in the company, because this is someone with inside knowledge who is not asking some random investor, but someone who knows and trusts him. From both sides of this, they would only be doing this if they believed they could make this work. Now, GameStop was paying out a huge dividend. In 2018, for example, it paid out what looks like a 10% dividend. And if these details are correct, then that was only 10% at that time. Most of the year, the share price was much lower, so the return on that would have been much more than 10%. Fortunately, this has stopped, and there is no more dividends being paid out recently, meaning the money is staying within the business and can be reinvested which is really important at the moment. GameStop have said that they are trying to create a social and cultural hub of gaming within each GameStop store, which appears to be similar to what Cohen was doing in Chewy. So I can see what they're going with that. This could see a really big tie-in from the Game Informer magazine as well as the new concept stores which are more focused on the game experience. These new store concepts are almost like gamer internet cafes, where you will still have all the usual products for sale, just a little bit more slimlined down. Many of the new stores actually appear to focus more on the toys rather than the actual gaming computer consoles. So the Think Geek range appears to be the larger focus here, only with a small amount of gaming products on display. And in the gaming section, normally at the back of the store, you can play a selection of the latest games. They also have a gaming couch and a community table where you can play board games. Along this, you can now get drinks and snacks as well. You can get 15 minutes to play a game that you might be interested in buying completely for free, or you can pay and play for longer. The whole concept of this is very exciting. It could help to not only create a whole lot more traffic of people coming into the store, but also revenue from gamers that have never been in before. Obviously, something you cannot get from online retail is the experience. And being able to try before you buy could be a great way to entice customers in, as well as being the place where you and your friends can go and play the latest computer games or participate in tournaments. This concept has only been rolled out to a small number of stores at the moment, and it started last year, just before the global pandemic. So GameStop has a huge global footprint and a fast-growing e-commerce store. In the last quarter, e-commerce accounted for 20% of their global sales, which has seen a huge rise, with figures like 1,500% growth in March. Now this is fantastic. The combination of the online with the brick and mortar footprint could be a huge boon for this company, as they would be able to capitalise on getting stock from people who are not online and then shipping it nationally very easily. GameStop's main customer base in their stores are those on a low income, people who are very unlikely to have either access to the internet or the technical knowledge to use the internet. With the current global crisis, this group of people is likely to get larger, with more people on the breadline looking to sell their games and electronics when they have to. And they will really accept low prices for these because they're going to be desperate for the money. These same customers will then come back and buy other items as well because they'll be able to buy it cheaper for second hand. Businesses like GameStop normally do very well in financial crises when people do not have much money. So with huge unemployment at the moment and the furlough schemes ending soon, we could see a huge boost in customer activity. Taking a look at its debt and its assets, it actually appears to have 435 million in the green. That is to say, if you bought the whole company and liquidated it today, you would have $435 million left over. As its current market price, you could buy the company for $396 million. So effectively, this would make 10% overnight. Now obviously this is only on paper, and I am sure there would be many other technical costs that would mean that this would not be physically viable. But those are the numbers. So technically, this company is undervalued purely on assets, not including the value of the potential for the company itself, as well as its brand. On top of this, you have a stock which is highly shorted. At one point recently, it had 250% of its available float shares were being shorted. To give you an idea for comparison, a lot of heavily shorted companies normally sit around 15 to 20%, with a few normally a little bit higher than that. This means if the company doesn't go bankrupt, there will be a lot of shares that need to get bought back in again. And it is not likely to go bankrupt because there is still a lot of cash in this business. And if forced to buy back in within a specific time frame, this could cause a short squeeze, which could force the price up. Now, there is a good chance that this may have already happened recently with the sudden climb, and maybe a chunk of that short interest has now gone. It's definitely not still showing in any places that I've seen. So it is impossible to know for certain, as the data that we can get is always old. It's impossible to get brand new information with regards to shorted stocks. But needless to say, there are a lot of bears out there. Much like when everyone and his dog are buying a company, you can bet it's going to fall. And the same can be true with a shorted stock. If everyone is going to sell has done so, then the only way is up. So what could the future hold for GameStop? Well, the second-hand market for the products that GameStop sells is still huge. A large amount of that market has moved online, and a really big investment is needed for them to really push forward here. There are a number of competitors in this market, from the likes of eBay, Amazon, Craigslist, as well as a number of other companies that are almost like Netflix versions. That is to say, you just send the stuff to this online company and they pay you for it, similar to what GameStop do already in-store and online. If they're able to grow this side of the business as well, I think this could really help boost the business to meet those customers who've had their local stores closed. They could also potentially add community selling side as well, and this would help to build that community that they keep requesting. This would make GameStop a truly omni-channel and could help them to maximise their return on products by being able to send them around the world to the best possible locations. They've also been trimming a lot of the fat in the business and freeing up a lot of cash. This hopefully means significant investments in the right areas for the future of this company. And if they're then able to use that investment to build up the company and build a true community of gamers that want to keep coming back to the shop to buy their games and be involved in their local GameStop, then you could quite easily see the company becoming profitable again and going back into the billion-dollar market cap and pushing that price to $15 a share. This combined with the fact that the new Xbox and PlayStation will be released just before Christmas, which normally gives GameStop a real boost as people trade in their old consoles, and also the new Christmas period is always popular in retail. This will also have had a negative impact on sales last quarter due to the fact that people are waiting to upgrade. So this golden quarter could be the real lifeline that GameStop really needs to help boost it back up. So what do you think? Are you running out to buy GameStop shares? Well, watch my next video first, because in my next video I'll go over the negatives of why you might not want to buy GameStop. Thanks for watching, and I'll see you in the next video.